Well, the red flags of investments. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I've got an answer for you. All you have to do is go to the website at prudentmoney.com. There is a link at the top of the page. You can just click through that link and you will see where you can send an email in. And if we can get you taken care of that way. If that doesn't work for you, a little bit more of a complicated situation, we can always schedule a few minutes over the phone and discuss in that way. Whatever it takes, we want to make sure that you get the resources that you need. That's all at prudentmoney.com. Let's talk a little bit about the Trump investment ideas. If you'll recall last week, for those of you who are listening, and for those of you who are not listening, to get you caught up, one of the things that I really want to pay attention to and talk to you about and make sure that you get a good understanding of is brand new administration. Of course, you got to factor everything that goes into a Trump administration because it's much, much different than your average one. Lots of change occurring. And so along with that change is what the effects of on various investment vehicles. So you have the opportunity to perhaps get into what you think is going to benefit from what President Trump wants to do. And we talked last week about technology stocks in general, and of course the AI stocks is one possibility. Well, this week I want to focus in on bonds. And bonds have been a horrible place to invest probably now for, I might be off on this, but you'll get the idea, 3 or 4 years. They just have not been very good. And the reason being is that the Federal Reserve Board, remember, they're the ones who raise and lower interest rates. We're fighting inflation, and to fight inflation, you have to raise interest rates. And if you raise interest rates, you lower bond prices. Okay, follow along with me. So if you raise interest rates, bond prices will go down. It's what you have to sacrifice something to slow inflation down and eventually get rid of it, which they still have not gotten rid of all of it. It's still in some ways into the economy. And that's the downside to raising rates, but that's just the way the cycles go. And so President Trump is calling, and we'll talk a little bit about why this is not necessarily a good idea, right? It's the potentials of being a very bad idea, but I'll tell you why I think they're doing it, is calling for all countries to lower interest rates. And most all other countries operate like we do. We have a central bank, which is the Federal Reserve Board, and they are in charge independently of the office of the president, independently of congressional leaders, independent of regulators. They are there to make that call whether interest rates should stay up or go down. Now, if all of a sudden interest rates started to collapse, which did not happen the very first time you mentioned it, well, then we would definitely want to keep an eye on that, because what we're looking for is the interest rates. If this were to happen, I don't think it's going to happen, but interest rates all of a sudden dramatically fall and they stabilize at a much lower rate, then it could make sense to look at what kind of bond prices are doing, what bond prices are doing, and determine whether you want to make an entry back into bonds. This is a dangerous situation because I believe, and this is just the dynamics of President Trump. It's not a pro or a con, it's just who he is. He does everything in dramatic fashion. And if he were wanting to boost up the economy, in other words, give it a steroid shot. When I say steroid shot, I mean a steroid shot that only lasts for a certain period of time. but get the economy up, get the real estate markets up again, get people in getting mortgages because mortgages fell, and all that happened literally within a couple of months. And to do that, we'd have to see central banks across the globe lowering rates at the same time, which I don't think that's going to happen either. But if it were to happen, the dramatic effect it would have on so many aspects of our economy would look really good at first until the inflation kicked into gear and a phenomenon known as negative interest rates kick into gear. I won't go through all that because the point is to say, look at bonds, keep watching bonds, because bonds, if interest rates do start to, even if they dropped a little bit, bonds could start to look like a good investment again. But this is something we want to watch real closely, because at the center of everything is the golden prize that everybody wants to control is interest rates. And that's why we've got a Federal Reserve Board that can't be fired by the president, by the way. And it's already starting to get a little chippy down there as far as Federal Reserve Chair Powell and President Trump, and where they both think interest rates should be. I think Chairman Powell thinks that we can't just automatically start cutting interest rates to lead the world to do the same. And he understands that and he's made some questionable moves as well. It's politics, but anyway, that's the whole point of where we're going with this is to keep your eyes on bonds, because those might be a good place to be. Okay, one of the reasons why I talk about red flags on the program is to save you some problems, because obviously scams, bad investments, things that can rob you of your money are happening every day. And so I like to go over things that, and here's the thing is you don't really have to understand the mechanics of it. You just have to understand and look for, boy, that looks like a red flag to me. And usually they come from the school of it's too good to be true. I've always been, and I tend, when I talk about different companies who are doing these things, I tend not to, for numerous reasons, read the name of the company. But there is a trading group that aggressively markets, and I'll just put it to you this way and read from the marketing. This is the home of Hall of Fame traders, the home of the 100% a year club. Now, if that doesn't bring out, it brings out one or two things. It brings out either a red flag or extreme greed, because people will look at it and go, investors will look at it and they'll say, well, how can I make 100% a year? That sounds good. Tell me where to sign up. And they're so far this year, they're quote unquote up 22% year to date. And so I always like to go to the disclaimers and tell you what the disclaimers say. Now, they're talking about all of these incredible returns, and they're talking about all of these, the 100% club, and now you get to the website disclaimer that says past performance is no guarantee of future results. Okay, that's pretty common. Inherent in any investment is the potential for a loss. Here we go. This material is for information, entertainment, and educational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, hold, sell a security. I can't get into let me say this, I choose not to get into the free trial, because I don't want to, I like to make sure that I got my money back. But they have a subscription service that's $2,750 a year. Now, if if they're not giving advice or buy and hold advice, when to sell a security, when to invest, and this kind of thing, then why buy the subscription if there's nothing of value in that? Especially they're touting their 100% a year club, so you would assume that they are connected. No recommendation or advice is being given on this site. No investment recommendation or advice as to whether any investment is suitable for a particular investor. Well, that's true. It should not be assumed that any investment in securities, companies, sectors, or markets identified and described or discussed herein will be or were profitable. Now, that is a very key piece of information in saying that there's nothing that says that any of this was profitable. All information is current as to the date of herein and is subject to change without notice. Any views or opinions or comments cannot be relied on for investment decisions. Let me read that again. Any views or opinions or comments cannot be relied on for investment decisions. In other words, their subscription is all pretty worthless that they're asking you to spend $27.50 on. You should consult a licensed securities professional before making any investment decisions. This firm is not a licensed securities dealer, broker, or investment advisor, or investment bank. I'm going to stop there because we are up against a break, and the disclaimers just get better, and it makes you wonder, what are they really selling in their free subscription? Hey, this is Bob Brooks, so we are up against a break. Stick around, and I'll be right back. Hi, my name is Bob Brooks, host of the Prudent Money Radio Show. So let me ask you a question. Do you know your numbers? Now, which numbers are those? They are your retirement numbers. That set of numbers is the single most important planning numbers you can know. Yet the majority of Americans don't even know them. Prudent Money Financial Services, sponsor of the Prudent Money Radio Show, specializes in figuring out those numbers and creating a game plan to make sure you're on the right track. Listen to the Prudent Money Radio Show weekdays at 3 p.m. on Bible School Radio 91.3.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need. So please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. I'm talking about these firms that advertise and market. They can make you rich, can make you 100% a year just by joining the quote-unquote 100% a year club. And there's an interesting set of disclaimers that make you wonder if this is all just trying to get you to buy a subscription service, which is pretty expensive. This says this firm is not a licensed securities dealer, broker, or a U.S. investment advisor or investment bank. Since they're not registered as a securities dealer, then they can't sell you or provide or get or invest your money into any type of investment that is not that is unregistered or registered as far as that goes. And so they walk a fine line on this one. Performance is discussed in our daily wrap, and where we use the trades and results from the trading portfolio, which is a hypothetical portfolio that is weighted and may use leverage in large quantities. In other words, this is the type of scenario, either how much of it is real or not real. You could actually or potentially lose almost all your money, which is hard to do these days. But when you start using tons of leverage in large quantities, like they say in their disclaimer, that's not a good thing. Here's my very favorite sentence of the entire thing. These are not the returns of an actual fund or portfolio of stocks. So what's again the purpose of all this? The trading portfolio does not buy or sell any stocks that are below 300 million in market cap and does not trade options. It would be really tough. Let's just say that they were the most amazing traders in the world. It would really be tough to score 100% a year. Can't believe I just said that. 100% a year when they do not buy or sell really big companies and don't trade options. It says it trades only in the stocks that are sent to subscribers via our instant text alert service. So if you have a text alert service and the text alert service says buy XYZ stock, isn't that the same as you taking their advice and buying XYZ stock? When the service notes we are buying. When it notes we are selling, we are selling. See, this is just a crafty way to use words and to confuse people as to what's happening, whether it is actual results or not. It says your results may significantly from that discussed on our website and in our hypothetical portfolio due to many factors outside of our control. It says might be different than what we're actually making. By using this site, you agree that your results are 100% your own. So you just signed off right there that you made your own decisions. Hey, this is what we're doing. We're not telling you to do this, but this is it. And it's a very gray area that some of these subscription services run into. That's why you always want to be careful and make sure that you are not getting mixed up into something that's going to be a waste of money and a waste of time, and could be a waste of your investment money if you took a big enough hit, which I think that you could. It also says hypothetical performance results may have many inherent limitations, some of which are described below. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Once again, why in the world would you want to sign up for this? No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. I could go on. There's 3-4 pages of disclaimers. And it's, I think that those types of things are as close to a scam. And it's amazing to me that, and I think a lot of it is just the securities regulators are just too busy that somebody won't get in there and shut them down, because that's just not right. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, the IRS announced 2025 retirement contribution limits. And, it's interesting to me. The government says we are looking at a retirement crisis, that people won't be ready for retirement. And the numbers and the statistics, of course, are black and white, and they don't add up to people being able to retire and depending solely on Social Security, or a big chunk of their retirement on Social Security. And I just got, one of the things that they talk about is that all employers are not providing 401k plans, and there's just not enough good places to go to where you can invest money. I mean, there's not enough regulated retirement type plans that a person can go save money and do it from a risk standpoint and prepare for retirement. Well, they have this 401k plan. The bottom rung, you can save up to $23,500. If you're over the age of 50, you still get this $7,500. So there's $31,000. Then Secure 2.0, which was a COVID legislation, added an additional catch-up contribution to those 60 to 63 of $3,750. So you're roughly at $35,000, which is for those who can do it, is a big chunk of money. So let's say that you have someone that can do it. They're going to a company that there is no type of retirement plan whatsoever. And so what do? Well, they can put money into a IRA, which is, as long as nobody's working, they can, or nobody's being offered and they're contributing into a retirement plan at work, like a 401k plan, they can contribute into an IRA up to $7,000. And if they're over the age of 50, they have a catch-up provision of $1,000, so a total of $8,000. So here's my question. If the opportunity is the main thing, and the opportunity to accumulate money is the problem, if you're going to allow somebody who's roughly 60 to 63, and by the way, the catch-up provision is a nice deal, but I doubt many people are aggressively investing at 60 to 63. Why not for everybody make the amount $30,000 to $35,000, make it to where you can put $30,000 to $35,000 into IRAs and be done with it? What something as good as a piece of legislation as that would be, to change up the structure of retirement planning, make it easy. Why not make IRAs equal with 401k plans, except for you get a potential match in the 401k plan? So that's never made any sense to me, why the government won't take IRAs and just call them a supersized IRA, to where they could max out up until to $35,000, even $20,000 or $25,000. I mean, most people aren't investing that high of a rate of their overall income at $35,000, but it makes more sense. Then you look at it and you go, well, you have to be really to take full advantage of the large amount that they're allowing you to put in 401k plans. You got to be between 60 and 63 to get all three phases of investments. And it makes me wonder if I promised I wouldn't get into conspiracy theories, so I'm not going to. But it doesn't make any sense. And for the reasons I'm thinking is why it doesn't make any sense, but I won't go there. What you need to know is what do I take advantage of, and how do I invest to max out with the opportunities that are in front of me? I would say, the rule of thumb that I have, if you don't have an emergency account put together, and you're aggressively investing into a 401k plan, I would pause, aggressively put money back I would pause up until the match. I would get the match, and then from money above the match that I was investing, I would build an emergency account, then start back. I think that, of course, you got to evaluate your own situation. This isn't giving advice, but it is something to consider. That is, if you have the ability to put money into a 401k plan, you always want to take care of the free take advantage of the free money or the match. That's very important to make sure that you are getting. Then anything above that, you could take and put back into a savings account and build that emergency account. Make sure that you're in a good place as far as if anything happened and you needed to use emergency account money versus going on a credit card. You've got that connection there. If you don't have anything available to you, still you and your spouse putting back, if you're over 58 grand a piece, could make a lot of sense. So those are some things to consider, and we'll keep you posted on what you need to know. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.